Hello, and welcome to Nutmeg's Investor Update for September. I'm Lisa Kaplan, Head of Financial Advice at Nutmeg. So if you have any questions about financial planning or need some financial advice, please get in touch for a free initial consultation. This month, I'm joined by Brad Holland, who's our Director of Investment Strategy. Hello, Brad.
Hi, Lisa.
Brad, we've seen a lot of volatility in August. Can you tell us what happened?
Well, August can traditionally throw up a lot of equity market volatility as market participants enjoy summer holidays. But this August there was far more going on. In the end, US stocks fell just under 2%, a little better than wider developed equity markets at minus 2%. Emerging markets fared worse at minus 2.5%. Now, bond markets were quite volatile after the Fed's rate cut on the last day of July. Over the full month of August, government bond markets put in a good performance, with gilts, for example, up 3.5%. On the currency front, the big news was the Chinese devaluation of their currency, the renminbi, the yuan. It fell 4% on the month, with a similar decline in emerging market currency baskets.
Okay, so if it wasn't just the summer seasonal pattern, what happened to cause the markets to behave this way?
Both sides of the US-China trade dispute raised the stakes during August. Both raised tariffs. China suspended agricultural imports from the US. As mentioned, they devalued their currency. And that devaluation partly offsets the effect of higher tariffs on China's competitiveness. Now, the US duly named China as a currency manipulator, and it was a pretty busy month. Now, because the state of the US-China talks has been one of the two big market drivers this year, the deterioration in talks obviously troubled markets. However, despite all this, both sides are keeping open the prospect for talks in September, when Chinese negotiators visit Washington. So there is scope for news to continue to influence markets.
You mentioned there were two key drivers this year. What was the other one?
Yes, the other is monetary policy, and that's been important in August too. The bond market's instinctive reaction to the July 31st Fed rate cut was to expect a series of further cuts. But communications from the Fed reminded markets that they are cutting rates as risk management rather than because of recession fears. Now, that's not stopped media hysteria about recession because of the level of the so-called yield curve. But we don't view the US economy at risk of recession, nor does the Fed. Unless the trade situation continues to worsen, the US economy looks solid. And that was actually the message too from the latest US corporate earnings. 3/4 of large companies in the US reported positive profit surprises.
So it's all about the Fed then?
Well, there are other central banks also. And they too are continuing to support growth. The ECB meets on September the 12th, and markets expect them to deliver further stimulus to the ailing Eurozone economy. Its industrial sector is suffering from the stagnant global trade picture. Now, the market also expects Bank of Japan to cut rates in this month or next because of the lackluster economy, the below par economy due to the trade situation. So all central banks are chipping in to support global growth.
That's the global picture. What about events closer to home?
Of course, the summer Brexit blackout is well and truly over, with the Prime Minister's attempt to suspend Parliament until the October 14th Queen's speech. A number of political manoeuvres could happen after we finish filming today, and we're keeping customers updated via our blog. But at present, we continue to see an early election as the most likely outcome. The impact on UK asset prices, including the pound, differs with each possible outcome, which is why we are underweight UK assets.
And how are our fixed allocation portfolios performing?
Well, the relative performance of equities and bonds meant that higher risk portfolios fared the worst. They declined around 3%. Mid-risk portfolios declined between 1% and 2%, and lower risk funds were around flat.
This month, our customer question is about gold. Given the market volatility we've seen, is now a good time to invest in precious metals as a so-called safe haven investment?
Well, gold is an asset class that's not easy to understand because it sometimes has opposing driving factors. Gold can be an inflation hedge, but you'd be hard-pressed to find investors who are concerned about inflation at the moment. Usually the gold price cycle moves in line with other mining commodity prices, but these are still all at rock bottom levels. So this isn't a normal gold cycle. Structurally, gold can be a hedge against systemic issues. Now, the gold price only broke above a 6-year range in May this year after the trade talks broke down. So gold may be reflecting concerns over the global financial and trading architecture. Now, of course, a resolution of the trade dispute would withdraw this structural prop for the gold price. Gold doesn't provide any income either, but these days government bonds don't either. So with yields so low and negative, and that's another factor that has turned some investors towards gold.
Thanks, Brad.
Thanks, Lisa.
And thank you for joining us. If you have any questions for Brad, please contact us via email, social media, or the comments section. Otherwise, we look forward to seeing you next month.